Hello, this is Jim Riggio. Today is July 24th, and this is the Monday Market Muse. We're going to be going over a different type of trade that takes advantage of the incredibly low implied volatility and the very steep put skew. We'll go over the details on that. But before we get started, a quick disclaimer. Capital Discussion is not a broker-dealer or investment advisor. The presentation you're about to see is for educational purposes only. We have no way of knowing what your situation is or what level of risk is appropriate for you. We're not making any trade recommendations. The risks of loss while trading options is substantial. Please be aware of all risks prior to placing any trades. Additionally, such factors as slippage, commissions, will end up having a variation on your profits. And with that, let's talk a little bit about what's been going on in this market. If you take a look at what's been going on in the implied volatility market, our VIX has hit near all-time lows. I ended up doing a study the other day that ended up showing that on Friday we hit the second lowest all-time VIX that we've ever had. Now the VIX has changed somewhat, right? So different people will tell you different things. So I'm just using the calculations that I got off of the internet from Yahoo. But when you go and you take a look at all of the data that you can end up finding, what you'll end up seeing is that, and here I'll bring the chart down and I'll show you. What I ended up doing was that I brought all the data in from the beginning of 1990, and then I ended up listing the 10 lowest days. Okay, what I want you to notice is that 7 of those 10 days are this year. Okay, if you also take a look at the top 5, 3 of the top 5 happened within the last week and a half. There was also one, at the 19th that ended up happening. So the implied volatility is incredibly low at these levels. If you take a look at all of the charts are pointing to a long upturn trend. When the IV is this low, we tend not to end up getting, huge market pullbacks. We do tend to end up getting some small market pullbacks that will end up bringing the VIX up to a double-digit range and not have it here loiter in the nines. So when you take a look at what's going on, there's basically a long-term view that is extremely bullish. I ended up showing last week how the S&P has only had 9 up months where the previous month's low was lower than the current month's low, something that our friend Andrew had brought out several months ago. Well, we've reached 9 months. That's only happened twice before in the history of the S&P. It happened back in 1983, I think it was, and then also in 1958. So the level of strength that we end up having in the long-term market is incredibly strong. Now, where do you end up going? Because there's no bonds to end up having, safe income or at least get some type of a market return that you can end up putting on. And I'm not talking about just options trades. I'm just talking in general. One of the things that was used very common was something known as a structured note. Okay, what a structured note is, it's basically a security that's usually built on a custom issuance. I've worked for several RIAs that would end up going to Goldman Sachs or JP Morgan or somebody like that to be able to end up getting them to build this type of a security for them. Now, normally, and I'm going to get into what it is in a second. Normally, what would end up happening is that the RIAs end up knowing, if I take a look at the long-term VIX, and I can only get 20 years of history here, okay, when I take a look at a long-term VIX, by the way, today we ended up hitting an all-time low. The all-time low was a 931. We hit 930 today. They would end up looking for volatility spikes, and they knew that when IV was high, right? When IV was high, what they would end up doing is that they would look to end up putting on these structured notes. And here's the way a structured note would end up working. They would choose some underlying index. The emerging market indexes was usually their favorite or one of their favorites because the implied volatility was higher, but they were tougher to sell. So they were also done mostly on the S&P 500. And so when volatility spikes or the VIX spiked and it was high enough, they would go to put these structures on. And this is the way a structure would work. It would end up saying that something like, and I'm just making this up arbitrarily, if the S&P stays somewhere between minus 10% and plus 10% over the next 2 years, okay, your investment in the security will end up paying something like, let's say, 3%, 4%. If it goes above 10%, you'd get to end up keeping all of the gains above 10%. If it goes below 10%, and this is at expiration after 2 years, you would have to end up incurring all of the losses below 10%. So when you take a look over a 2-year period, because the market does end up trending to end up going up, you've basically gotten a way to collect the dividend and then some without a lot of risk. Because if you take a look at how many times the market's been down over a 2-year period, what you'll see is that it's very, very infrequent. And so if volatility is a little bit higher, the market's already sold off somewhat, you have a chance of being able to get a nice return. Sometimes when implied volatility is high enough, instead of a 3 or 4% return on these things, you could end up getting a 5 or 6%, maybe even more, if the implied volatility was high enough. And you would end up signing up through your registered investment advisor, and he would end up or she would end up building these things, usually with the help of a Goldman Sachs, and it would actually be a security. So it would be kind of a wrapper, or we might end up as options traders, we might call it a combo or a risk reversal type of trade that is long-term, and it's a security. They would normally make these things 2 years, because this way they would say, well, we had to end up going to Goldman Sachs because those options aren't traded on whatever index that we wanted to end up doing. And it worked reasonably well for people who were starved for interest. It was a very reasonable way to end up making money over the longer term. Okay, let me end up showing you. Let me move this over to the side. And I will end up showing you basically one that I had built for some folks several months back. And it looked like this. Okay. So what I ended up doing was that I built it about around election time or so, I think it was. And it was as follows. I ended up having a range, and they wanted something that had more upside potential. So I ended up taking a look at, and let me reset my slices. They wanted something that had more upside potential. So when we put this thing on and we were around 27, they wanted to have all of the gains going up to 250. And they said we can end up absorbing the losses down to around 205. And so what I basically did was that I bought the S&P 500, so they collected the dividend. Then I sold a covered call for $9 going out to December of next year. Okay. Then what I ended up doing on the downside to protect the long strikes, I ended up putting on a vertical. They wanted it this way for a very specific reasons. One, they wanted to collect, right? They wanted to collect the dividends so they could end up having that bear the interest on a regular basis to their clients. Okay, so they got the entire dividend while we ended up running this trade. Okay. And it was a very reasonable trade. They took a look at what their margin would end up being. Now, their margin requirement is going to be relatively high. And here's why it's going to be relatively high. Because what ends up happening is that we're buying the actual stock. What ended up happening is that they did need in a IRA or a cash account, they did end up needing to put up the $18,000 or so. But having a return where if we just moved up, okay, 2.5% on the market over that period of time, they would have something that would end up returning 10% on their money. They really liked that concept. Okay, so these things are usually built for the custom view of the investment advisor. Okay, any questions about this? Can I just take a quick survey? Has anybody ever invested in a structured note, or know what a structured note is, or even looked at one? Okay. Usually, you have to end up having if you just write in the chat, or if you're dialed in, you can. Okay. Most of you haven't. Usually, they're built for investment advisors that are managing larger client account size. The people that I've built this for, meaning the investment advisors, many of them had minimum investments of a $500,000 or more. And so, what would end up happening with something like this is that an RIA, right, an investment registered investment advisor, who let's say has 500 million or $1 billion under management, would go out and maybe buy $1 million worth of this stuff, maybe 1% or 2% of their clients' portfolios, and then they'd end up putting into most of their client portfolios. So would you end up putting something like this if you had 30 or 40 other bonds? If you were an investment, is this a fine investment to take with 2% of your capital? Without question, it was. Okay. The one challenge that they ended up having is that they were going to be buying this in cash, so they didn't care about the cost of buying the shares. And so that's the way I ended up building this one. And like I said, it was a few months ago. And you can see it has a nice return. They're very, very happy with what they end up having because they're comparing this to bonds. Okay. In less than a year, they've made their, 6% or so. They feel that it's much better than they would have done in any type of bond. And they didn't end up feeling that the risk was that great. Okay. By the way, that's what the structure is up. This doesn't include the money that they also got to end up keeping on their dividend payments. So they're 6% above the dividend payment. So they're just ecstatic with the way this is moved forward. They ended up asking me, along with another RI, asked me to build other ones. And because I was able to end up building them when the implied volatility was a little bit lower. Okay. The challenge, okay, when the implied volatility is lower is that I'm not getting enough money for this covered call. Okay. Yes, the put is more expensive, but if IV is really, really high, what tends to end up happening is that the percentage difference between the implied volatility of the call and the implied volatility of the puts isn't nearly as much. So therefore, when implied volatility is lower, you tend not to end up getting the same nice risk rewards. Okay. A couple of other people end up saying that they had a friend who buys them all the time, but he does have a brokerage account with Goldman Sachs. Yeah, like I said, it's the big guys who tend to end up writing these, and they ended up writing these as structures for if smaller RIAs would want to end up buying them. If you have, it's a way to be able to consider relatively safe income, because a lot of these things might end up being, if the S&P doesn't go down 10 or sometimes 20%, if IV is high enough, I can end up writing these things where you can end up making a return and you don't end up incurring any loss unless the S&P goes down another 20% from where it is. So if the market pulls back, let's say 10 or 15%, to write one of these things is absolutely great because IV is really high. Okay, and you don't have any incurred loss unless you're down another, like I said, 15 or 20%. It doesn't work like that when the IV is low. And so after a conversation, they ended up asking me, with IV low, if we ended up giving you like free reign, is there anything that you could end up doing? Okay, and so I ended up having basically the ability to do almost anything that I wanted to in terms of drawing how I wanted to have this risk reward graph look. Paul, was that you? Any? Yeah, because I know that you end up having your friends. You ended up mentioning that. Let me do that again. Any comments or any other questions here? I don't see any. Okay, so I'm just looking at the puts. And so what I'm going to end up looking at here is I'm just going to go out to, let's say, September of next year. So I'm only going to end up looking out about a year only on the monthlies. Okay. Second thing I'm going to do is I'm only looking at the puts. And what I'm going to do is that currently we're around, let's call it 245 generally. So I'm going to end up taking a look at this area of the graph. Let's take a look at maybe down to 200. Okay. So what I want you to end up seeing, and here are the implied volatilities. Let me see if I can get this to be a little bit low. Here are all of the colors that make up the line. Normally, I'd end up showing you this um, in LiveVol, but I know that none of you use it, so I'd rather show you something that was useful. All I've done is I've gone down to options, product depths. I'm looking at just the puts. I selected the strikes I wanted. Or the expirations I wanted. I'm looking at implied volatility, and then I highlighted. Here's what I want you to see. As you get closer to expiration, you see the colors over here, right? And so magenta, or this pink, is this line. It's the highest below the money and the lowest slightly above the money. And then aqua is next, and you can see that's in October and then November. And as you go out, the implied volatility gets lower when you're far below the money, but it gets higher when you're above the money. So one of the things that does end up happening is that the implied volatility of the calls above the money will end up dropping rather significantly with time. But don't forget, we also have theta that's affecting. So these things kind of get hurt pretty badly. Whereas on the downside, the implied volatility tends to end up rising. However, even though the implied volatility rises below, the theta effect is usually much, much more. And so this is very much a trade that the people who were looking to structure this for their clients were willing to end up holding this to expiration. And normally, most structured notes are held to expiration. You can get out of a structured note, but if you bought your structured note from Goldman Sachs, the only person you can sell it back to is Goldman Sachs. And hence, what ends up happening is that they become rather expensive in the sense that not everybody wants to end up getting out of them. And since you can only sell them, okay, back to Goldman Sachs, if that's where you bought them, they kind of have a captive market. And so your risk rewards usually aren't good. Your bid-ask spreads are going to be wide. It's usually not a good idea to do this. If you do need to end up getting out of it, you could. One of the very big advantages, okay, that the company had when I built them, these, is that I was using SPY options, as you saw in my example, and if they wanted to get out of them, they could get out of them in a very liquid market. Okay, so that was something that was very, very strong. So I ended up having a conversation again with their chief market strategist, and he wasn't concerned that the markets were going to end up pulling back, okay, between now and, let's say, the end of the winter, okay, into at least the first quarter of 2018. He didn't think that we were in risk for a bear market. He thought that there might be some small corrections, 10% or less, but he didn't see a more than a 20% drop, okay, from where we were. And if we did end up having one, he felt that the market was so strong with the anticipated tax cuts is the biggest thing. The increase in the economic indicators, earnings have been very good. So he gave me all of these reasons why he felt that the market was going to end up going going up, and we talked about it. He's not so much a technician, and we went through all of the technical analysis. And I said, from a market and a technical analysis, and if you take a look at support levels and resisting levels, and you take a look at trend lines, everything, okay, with some minor exceptions, and they're only in the short term, also point bullish. So he felt, okay, fine, get me the best risk rewards you can, but I want to have reasonable assurance that on the downside, give me as big a cushion as you could. And he was very concerned about it because with the implied volatility this low, he knows that cushion he has to the downside is usually much less. Now remember, the whole purpose of this that they started on was because they wanted to be able to have some type of yield, right? Some type of interest, some type of payment that would end up coming in as long as the market didn't go down. The problem with doing that is when IV is so low, I'd have to give up way too much. So given the fact, okay, that we have a market where we're basically at all-time lows in the VIX, but yet the puts below the money, okay, are relatively expensive compared to the puts at the money, and even more expensive when you end up considering them versus the calls above the money. And so what I did was I looked at the curves in terms of the implied volatility, and this is what I ended up doing. I went out to March. Okay, I knew I needed to go out into at least next year, and what I was looking at here, and I want you to observe this. I want you to take a look at these puts far below the money. Look at where the implied volatility is. Okay, in the mid-20s. Now let's take a look at where the calls are above the money. They're in the 10 range. Okay, 10, 11 range. And so, I've told you this multiple times, joking in a joking way, saying, here's the secret. Shh, don't tell anybody. The secret to making money in trading options is to buy low and sell high. That's the big secret. Shh. But if you take a look at it, because you've been following, the markets and understand options enough, that implied volatility is just another way to end up saying, is this option cheap or expensive? Because you know that the implied volatility is being implied from the current price, right? It's just taking whatever formula you use, Black-Scholes, binomial, the Nordic guys who I can never pronounce their names, so I'm not even going to end up trying. Okay. But it's always going to end up being the higher the price relative, the higher the implied volatility. So I went out and I ended up doing the work to find out where was the highest implied volatility that also gave me the most amount of time below the money, and the lowest implied volatility that also gave me the most amount of time that was above the money. And here's why I say gave me enough time. What I want you to end up noticing on this, and let's highlight this a little bit more, like to here. Oh, get rid of that. Okay. What I want you to see is the following. Okay, what ends up happening is that if I take a look at the low point of the first month, September, you can see that this low point, something that Paul Demers and I have been calling the belly of the curve. Paul ended up called it the belly of the curve one day, and I haven't stopped using it since. But you can see the low point of the implied volatility slightly above the money. If you go out to the next month in October, what you can end up seeing that it's a little bit higher. Okay. If we go out to the next month in November, it's even a little bit higher than that. So what I wanted to end up doing, is that, and you can see here, this is just noise because of the puts. Don't worry about those. But as I go further out, and I started to take a look at the calls, and let me just take a look at the calls because there won't be the noise on the upside on the calls. There won't be the noise, but you have all of the stuff on the bottom that doesn't work so well. And so if you end up taking a look at where the belly of the curve is, and it's not the greatest viewpoint, but you can see as you go out in time, the belly of the curve gets further and further above the money. So I wanted to buy something out with enough time where I could buy the low portion of the belly of the curve. Okay. Um, so it would be the cheapest that I could possibly buy, but I also wanted it closest to the money. And the reason why I wanted closer to the money is this way we could start to end up making money on our gains if I bought this call, right? Because I plan on buying the low IV and I plan on selling, okay, the high IV. And if I come back and I take a look at the puts on the downside, and it's something like this, I'm going to want to end up selling something that's out here that's a high enough implied volatility. And after I had done all of the analysis and I brought everything down, I thought being able to sell a put that had close to a 2 times, okay, relative number than what we would end up buying ended up making sense. So meaning that if I bought an 11, I'd like to sell a 22. Right. Yes, I could end up going even more. I can get up to 2.5 times. But if you take a look, I'm going to spend 29 cents to end up, I'm going to spend 29 cents to end up buying this option to maybe collect 40 or 50 cents. There wasn't enough money in that. And so I needed to end up having something that would end up yielding something a little bit better. So the strikes that I ended up choosing and that we ended up using was as follows. I ended up taking a look at buying something that was 260. Okay, so it was slightly above the money. Okay, when we ended up putting this thing on. Now, granted, the markets had moved up a little bit last week, and now it's moved back down today just a little bit. And so when we ended up buying this, it was a little bit cheaper. Okay, but also the puts were a little bit cheaper. And what I did on the downside is that I looked at going down something more than 10%. I wanted to collect enough money. So on the downside, I was looking at selling the 205, and on the upside, I was looking at buying the two. I'm sorry, not the 205, the 215. Okay, and I was looking at buying the 260. So I'm selling the 215 put and I'm buying the 260 call. And at the time when we were looking at, oh, by the way, I'm sorry, I'm in March of 19. I'm like, these prices aren't right. We did this in March of 18. Same exact concept, but the numbers are going to be a little bit smaller. So if I take a look here at the 215, you could see that one would have cost me money, and that's why I wouldn't do something like that. I would have had to go further out of the money on one side. I wouldn't have had the same type of range, and so I know one of the questions I'm going to end up getting is why did I choose the strikes that I got. So now you see why I didn't do these strikes out in March of 2019, because the 2019, if I ended up going back to where it was, where I was on the 2019. When I took a look at the 215, you can see that the 215 was less than what I'd pay. So I'd only get, $4 and I'm sorry, $9.44. I'd receive that for selling that, and it would end up costing me, $10.21. And I want to do this for a break even or a small credit. I don't want to end up paying, a buck for this. And I would have if I had gone out in March of 2019. You can see it, by the way, the same way. If I end up clicking on the date and I go out to March of 2019, you can see that it cost me $1.23. Don't want to spend $1.23. I want to end up getting 41 cents. And so what I did was that I looked at the time frames and where we were, and matching what his thought on the market was, we ended up coming out here, and I did those strikes again, the 2015 on the downside. And you can see that this I ended up getting $3. I got $2.91. Whereas on the call side, okay, it only ended up costing me $2.50. And so there was a 42-cent difference, okay, in our favor that we would end up getting for a credit. And this is the way it looks. Now, remember, he said that he didn't want anything to end up costing his clients anything if we went down at least 10%. And so when I take a look at, and that should have been a minus 13, and this should be a 5. Let me do it this way. It's going to be, I was doing them backwards, that's why. Let's go to a plus 5. Okay, so here was what our P&L looked like at expiration. Remember, that's what he cares about most. What does it look like at expiration? So the answer is he makes a few dollars. Okay, what's 41 cents on an index that is $250? The answer is enough to pay the commissions and to be slightly positive. Okay, it doesn't cost them a penny to end up putting this thing on. They can end up getting on, which is basically a no-cost trade. How much does the market have to go down from today for them to end up losing money? The answer was, at least when we put this on, it was about 13%. Now it's maybe 12.5%. Where do you start to end up making money? When we ended up putting this on, it was we started to make money above 5%. And so what ended up happening is that the whole thing is just shifted. If you take a look at my graph when we put this thing on, it shifted a little bit to the right. And so the bottom line on the trade was that his clients are going to be able to participate in any gain above 5%, okay, between now and March. So that's, in 8 months. Over the 8 months, any gain more than 5%. What will it cost them? They have to end up enduring the loss, okay, if the market goes down more than 13%. So from a risk management point of view, he kept asking me, I get to participate if it only goes up 5%, and I don't have to pay anything if it goes down 13%? I'm like, yeah. And he kept saying, like, what's the catch? What's the catch? The catch is the following. What he normally ended up investing in is he did this if it stayed anywhere in the center, it might end up paying, 2, 3, 5% plus dividend. I said, here, you don't get anything and you don't get the dividend. I've used all of that money that you would normally end up getting, and it isn't very much, by the way, because we're at all-time lows in the VIX, and I've used that to take advantage of the put skew, right? Since the put skew is very steep, meaning that, and we saw this over here, meaning that the implied volatility of our options over here is twice what our implied volatility is over here, meaning that the puts below the money are much, much, much more expensive than the calls above the money. Okay, I ended up using that difference, okay, of selling something with an implied volatility twice as high as what I was buying as the advantage. And I converted what would have been their normal yield to just great risk-reward parameters of participating in the market above 5% and not having to pay anything if the market goes down 13%. This is a way to be able to end up trading the markets that the market gods are giving you, right? Normally, what would end up happening is that we are premium sellers. But what do you do when premium's at an all-time low and you're not getting compensated for the risk that you're taking? The answer is you use what they are giving you. They can't take everything away. It's almost like the game of whack-a-mole. They can slap one advantage. They can slap one of the moles down in one place, but one pops up someplace else. The analogy in just about any type of sport, whether you play football, soccer, lacrosse, the defense can't defend the entire field 100% of the time. Right? If they're going to end up overloading, okay, and they're going to end up making the implied volatility super low, okay, on the VIX, it means that they're going to end up opening up some type of an advantage someplace else. Where's that advantage? The way you find that advantage is that you're going to have to, here's the secret again, buy low volatility, sell high volatility. We have a trade here that takes advantage of the current market about as best as possible, that's out there. Okay, um, and so that's the trade that we ended up putting on. Okay, when we put it on, we got just about this. We got about 40 cents for it, um, and it's I think a really really great risk versus reward trade for somebody who's willing to end up holding this towards expiration and has a market view, a confident market view that we're not going to end up entering a bear market and be down 20%. Over the next few, 8 or 9 months. Okay. Questions, thoughts about how we're taking advantage of the implied volatility and what we're doing here? There's got to be something. Paul, Andrew, somebody help me here. Okay.
I just think the scenario is great. I think it aligns with the market because I don't see this market suddenly going down 20%, unless, aliens land and start attacking Washington, D.C.
I think that'd be bullish.
See, you know what? I have some Democratic friends who said that's already happened.
It's going to take some work for the bears to set up. I think anything more than a 5% move down, and that's going to take at least several months to play out. They're going to have to demonstrate some strength, which they have not done so far. Every pullback, the bulls have bought aggressively.
Exactly.
Right.
So one of the things.
Plus the tops. I'm sorry, Jim.
No, please.
I agree with Andrew. One of the things that happens, we have V bottoms, we never have V tops. It's the topping process. We may be in that topping process, but that topping process can go on for months.
That V bottom and V top, the fact that V tops don't have, that was the chief market, analyst, for the RIA. That was exactly his point. So he ended up asking me the following questions. Can you give me some statistics about how often this trade would end up working? Okay, very reasonable question. I need to be able to end up having some type of idea about what percentage of time are my clients going to be able to end up participating in this upside starting at 5% versus having to end up having the loss at more than 13%. Now, for those of you who end up remembering the distribution chart that I ended up showing you before, here was that chart. Now, for those of you who hadn't seen this before, let me explain what this is. I can end up looking at a bunch of different indexes. Here are my different indexes that I have loaded up. Okay, I can take a look at the S&P. Okay, and I can say how often has the market go down? And I'm sorry, I grabbed one that I haven't reloaded with the data for almost 2 months at this point, 3 months, and I took a look at what happened from the beginning of the S&P history to the last date that I downloaded. Okay, and I took a look at, what happened more recently? What happened in the mount or the run-up from, let's call it the bottom of the financial crisis, April 1st, 2009, up until the point where we felt that all of the high-frequency guys got back on the page, back on the same page, and have been in full force since. And that was the end of 2013. And what's happened since then? And then what I ended up doing is that I said, how many days between now and the expiration when this trade would be on? And the answer was 165 trading days. I then ended up taking a look at, how much has the market moved over a 165-day trading day period during these three different ranges? So during the all-time history of the S&P, here is the range, and let me just move this up a little bit so you can end up seeing. Here is the range difference. So what I'm asking is, how often will the all-time range be below 13%, right? That's the question. Well, to make it a little bit easier, I actually did the math over here. The answer is about 7% of the time, okay, we're going to end up being below 13% during all-time history of the S&P. How much will we be above 5%? The answer is about 55% of the time. And so I kind of take a look at, I have an all-time risk loss of 7% versus a 7% chance of losing this trade versus a 55% chance of winning this trade. And in between, it's a break even. Okay. So when I showed him these statistics, he thought, it was like, wow, this is almost a no-brainer for my long-term clients. Now, I also took a look at the different ranges that we wanted to take a look at. You can end up seeing that obviously that we haven't had any real significant market pullbacks during this period here, right? During beginning of 2014 till today. So how many times has the market ever gone down? What percentage of days have we seen a 13% loss over a 165-day, which is what, about 7.5 months of trading days? It hasn't happened at all. Okay. How many times have we been above that? The answer was 69%. If you take a look during the market run-up that we had, even though we had some really nasty pullbacks, okay, it still only happened 4% of the time. From 2009 to 2013, the market, okay, in terms of every single trading day, how many times was a trading day 13% lower than it was 165 trading days before that? Only 4% of the time. So, no matter how you look at this, you have a 7% chance losing, okay, and I'm using the most conservative numbers that we have here, a 7% chance of losing and a 55% chance of winning. Okay.
Those numbers are without using any sort of filter either. Obviously, you could come up with a filter to eliminate, at least some of those losses.
Oh, without question. One of the things that when we took a look at it, and the reason why he wanted different ranges was going back to the same comment that he made, that Paul made just a little while ago. You don't tend to have V tops, you do have V bottoms. And so if we are in the topping process, that's why he talked through the first quarter of next year. That's why he said, I don't know about 2 years from now. Yes, we could have more of a pullback. In his opinion, we could have more of a pullback where, at least in the long term, what he's looking at long term is, next 6 months. Okay, where do I need to position myself, okay, for the next 6 months? This trade fit perfectly into their portfolio. Okay, and again, here was the analysis that we ended up doing on it afterwards. He said, well, what does it mean if we're up or down 15%? Well, that's pretty easy, right? If you're down 15% and you're down 2% further than here, that means you lose 2%, right? 15 minus 13 is 2%. What happens if we go up 15%? Well, that one's easy also. You end up making all of the gains above 5%. So 15 minus 5 is you make 10%. So in his forecast, not only was he thinking that he was going to end up risking, okay, and winning this trade 55% and losing it 7%, but he also ended up thinking of it this way. He thought, I'm risking, okay, 2% of the money that I put at risk to make 10%. So I got a 5-to-1 payoff on this if we move equidistant, up or down 15%. And so overall, again, this is not an options trade. This is a trade to be able to end up replacing a structured note. Now, the problem with structured note investors is that they are accustomed to getting money back in this middle period here. That's why they're investing in it. And once I end up explaining to the RIA, because implied volatility is so low, which he knew he wasn't going to be able to get any money, but he had read someplace that the put skew was steep, so he said, can you take advantage of this? And the answer is, of course you can take advantage of it if you know how to end up looking. So very much so, even if you guys don't end up putting on this trade for your mom, okay, and this is a mom trade, right? This is not an option trade or trade. Um, this is a trade that ends up showing you how to have the mindset to go and take advantage of any type of environment. Because these low implied volatility, super steep put skews really hurt a lot of our types of trades. Paul, you know that buying those teenies below your Jeeps are super expensive. Because I end up kind of having my hedge built into my Kevlar on the downside, it makes my Kevlars, okay, difficult to end up making money. I won't lose a ton of money, but yeah, I can end up going towards a 5 or 10% loss on a monthly trade on something like this. As the market keeps marching higher and higher and higher, this is a great risk reward balance.
The one caution I would say here is that with the market as extended as it is, the chances of it going significantly over 2,600 are probably lower than normal.
They probably would be, right? They probably would be.
Well, a year and a half ago, we were saying the same thing.
And Paul, not only was I going to end up saying that, I was also going to end up coming back to here and saying, okay, Andrew, so maybe we're only may win this trade 50% of the time, and we lose it 10% of the time, right?
Oh, it's still a great trader's equation, but obviously the higher we go, the less there is on the upside.
Yes, I'll agree with that. I have just a quick comment, Andrew, on your, when you talked about, managing the trade to the downside. Especially with this, with all the trades, you have to. It's interesting. I have a automated back tester, and what I've found in the past that you have to be very careful when you start managing the downside because your equity curve of the returns, it's dramatic. It was surprising how dramatic the difference was, and that's one reason why I don't put the teenies on unless I need them. So you have to be careful where you start managing the downside risk because anytime we do that, we really, it's amazing how much money these things make when we put some of these trades on as no touch. And the problem is living with the drawdowns.
That's a big problem. That's a big problem.
Just a tad, yeah.
And the problem is that if you're investing say $50,000 in a trade where it can get hurt on the downside, but it's in a $250,000 account, so you can reload. It's not that big of a deal. If you're investing in $50,000, okay, in a trade in a $50,000 account, then it becomes a bigger problem because you have no money to reload it.
Absolutely. And so these trades are done in, I use a lot of, my risk management now is going to sizing of the trade compared to the portfolio.
Okay.
You'd be really surprised at the returns of a regular iron condor that's a no-touch over the course of 10 years.
Yeah.
Even with some big drawdowns.
And and that's the whole thing. Some people don't like the drawdowns. I have a question for both of you, since you end up saying that as the market goes further up, okay, there's less of a chance that it'll continue to end up going up. What do you guys know that I don't know? What's changed over the last 9 years?
Well, there's not much.
Okay. Right. Here are the last 9 years. Okay. So the further we go up.
Right. But, we had graphs that look like that in from the early 90s to 2000. We've had graphs like that look like, kind of look like this in the early 80s up until 87. The problem is you never know. I mean, that's the issue.
Right.
We just never know if it's ever going to happen or when.
You're talking to a perma bear, so I've been saying the same thing.
I've had to go to a 12-step program to get out of doing that.
Well, unless they've eliminated bear markets, then my statement that the higher we go, the less the room there is always going to be true unless we've eliminated bear markets. But again, obviously you have no clue how high it can go.
Right.
What I do know is that this market is incredibly overbought. Um, the that measure that I talked about where it's been I think 7 or 8 months where one month hasn't gone below the other. If you look at a monthly chart, normally that period is like 3 or 4, maybe 5 months before one month goes below the other. I think this is the longest that I could find. I think we're working on 8 months now.
It's the
Yeah.
ninth. It's the ninth, and
Well, it's not.
you don't.
It's not over yet. Yeah. But,
Okay.
Yes.
You don't have your data doesn't go back far enough because I ended up getting all of the data, and the answer was it's happened twice before in the S&P, and I mentioned this earlier. It happened in 1983 and 1958. Those were the last two times when you had 9 months where the lowest low of the current month was higher than the low of the previous month.
yeah. And
Happened twice in the
83 was
history of the S&P.
83 was the beginning of a rip-roaring bull market.
It was the beginning of a rip-roaring bull market. This data, it only goes back to mid-1997. But in 1986, okay, and this is the S&P. This isn't even the Qs. If I end up showing you the Qs, let's stick with the Qs because that one's even more fun. Okay,
I mean,
so
I've been waiting for I have a lot of unallocated cash that's sitting on the sidelines waiting for a good correction so I can start buying some dividend stocks. I'm afraid I'm going to have to leave that to my kid.
yeah. Back a year before this chart ends up showing, actually this is 1999. It doesn't have, okay, will it give me in the NDX? There we go. Okay. So back here a year before this, we were a little bit lower. The NDX was at 1,000. It was actually a little bit lower than 1,000. And a guy who I consider to be pretty smart, a guy by the name back then, a guy by the name of Alan Greenspan, called the run-up that happened up until 1996, meaning to the left of this chart. He said that the markets were acting irrationally exuberant. Okay, the markets went up more than 600% after his comment.
Right.
Now, I'm not as smart as Alan Greenspan, and just because markets end up running up, it doesn't mean that things can't go up. Yes, they did come back down. I get that whole thing.
Did it go below the 1990? Did it go below with a point where he made that comment?
No, not really.
No, it
Just
didn't.
gave up
It
on
came
you.
back down to almost the same level many years later. Okay, but he said it when the market was just starting to rev up. We hit the lows during the low of the recessions after the dot-com boom. And when you end up going to that, I'm going to end up choosing a guy who is probably considered to be the grandfather of all of the economists, John Maynard Keynes, who said markets can remain irrational longer than you can remain solvent. And so, am I going to end up making a bet that would threaten my solvency, meaning my bankruptcy? Of course not. And that's why. When I talked about this trade as a whole, okay, I ended up saying it was a nice trade that they're going to end up using probably with about 2% of their capital, okay, not more than 2% of the capital for each of their clients. So if it does go down more than 13%, their loss would be, minimized. If you think about it, if the market retreats 20% from here, they have 7% of risk. Okay, that was something that would end up being acceptable for this type of risk-reward ratio. One of the things that I got
better than being in an index fund, that's for sure.
a lot better
Absolutely.
than being an index fund. Okay, a lot better than being an index fund, and a lot better. They're putting on this trade, right? Putting on this trade. If you pay $1, okay, a dollar a strike, okay, with no commissions. I mean, with no ticket charges. This trade is going to cost you $2 to put on. Okay, it's going to cost you $2 to put on. Okay, and so take that out of the $40 that we're collecting, right? Because for one contract we would collect $40, the 40 cents. I got asked a couple of questions, okay, on this. So first, let me show you the easy way to figure out how much you would end up making in terms of dollars. Okay, if you're lazy and you don't want to pull out your calculator, your HP12C like I do, what you end up doing is that you take the date and you bring it all the way to expiration. That's number one. Okay, and I will end up going to March expiration the 17th, and so now my expiration graph is the same. Next, what I end up doing is in our example, we said what happens if we go up or down 15%. And so here's my loss and my gain of a 15% move and a 15% down. So the way they viewed it was for every contract that I do, I'm risking $513 for the possibility of making $2,381. Now, that assumption says an equidistant move up or down 15%. Now, we know that we don't have an equidistant move up or down 15%. And how do I know that? I went back to this graph and I said, what happens if we go down minus 15%? Okay, a loss greater than 15%. Okay, so if you take a look during the history of time, what's the chances that we go down 15%? 5.5. What's the chance that we go up 15%? Almost 22. Okay, and that's through all of history. And so you don't have that. Remember when I said I needed to go out far enough to allow the market to end up working for us? If you end up going and you have the market too close to you, meaning what's it going to do tomorrow? The answer is it's a coin flip. But what's it going to do in 1 year or 2 years, or in this case, 165 trading days? The answer is that over the long term, okay, the market has an upward bias. So we needed to give it a long enough term for two things. One, to let the longer term upward bias end up continuing. And two, to let the market analysis and predictions of the RIA, who said, I don't think we're going to end up having a significant sell-off. And going back to Paul's comments, V tops don't happen very often. And so we had great risk reward. Again, okay, taking a look at what the chances are going up or down. So on the downside, we had a 6% chance that this would end up happening, and we had a 22% chance that this would end up happening. Granted, over time, and I'm not taking any market bias in, but remember, I'm the math guy, I'm the probability guy. I'm not telling him about his market predictions. I let him do that. I just tell him, here's what history says. There are a couple of questions on this that I wanted to end up going to. One of them was, what happens with an increase in volatility to this trade? Because he's planning to hold us to expiration, volatility wasn't that important to him, because he said, I realize that if it goes down, I'm not going to be able to get out of this quickly, and I may have to end up holding it to expiration. And that was a real big key, because if I end up resetting this to today, and we did have a V top, and we dropped 10% tomorrow morning, which has never happened, okay, in the history of the market. But let's say it happened for the first time, okay, tomorrow, and we ended up having a 10% drop, and implied volatility ended up going up significantly. Okay, you could end up seeing that if volatility went up to 30, we would end up losing around $1,600 on the trade. Okay, it's not something that he felt a lot of risk with. And what you can end up seeing, that if, let's say that drop happened, as we got closer to our trade date. Let's not be Grinch and have it happen during Christmas. So let's have it happen at the end of January. Okay, I'm sorry, I need to do that over here. Wrong one. Let's say if we ended up having the market drop 10% and volatility go up to 30 by the end of January, right, what you can end up seeing is now that loss would only be about $800. So the further we end up going out in time, the less a drop in the price and a skyrocket in the volatility would hurt us. Okay, so Andrew number two, who asked me the question, it really depends on when that happens. He wasn't concerned that we were going to have a bear market in September. We've been too strong here. Might we have a little bit of pullback? Yeah, but 5% he wasn't too concerned about. Getting more than a 10% drop was something that I didn't think could end up happening, or at least not forecasting in his forecast to happen. Um, during the entire time of this trade. Another question was, suppose that there was a 5% correction in August into September. That's a much more likely scenario, and one that we did end up going through. So let's now take a look at, I'm going to put two things in here. Let me come over to here, unlock this, and do a minus 5% over here. Okay, so here are my slices. My slices are current price, minus 5%, minus 10%. Let's end up going to the end of September. Right? Everybody ends up liking to talk about September, but August is, September and October tend to end up being the worst months during history. So let's go at the end of September. So now what ends up happening is that at the end of September, a 5% drop, which is something that he could end up considering to be substantial, might end up being around a $300 loss if vol didn't spike. If vol did spike, a $500 loss per contract, based on what our potential gains were. Okay. This was not something that he worried tremendously about, because the type of pullback that he did consider, and it was exactly what I don't know who SSKK is, but what SSKK typed to me was that if we do end up having that 5% drop, from where we are now in September, and vols go up, that would probably be right now. One of the things that does end up happening in the trade is that if we do end up grinding up higher, let's say, up another 10 or 20 points on the S&P, now what ends up happening, that's not a 5% pullback, that's a 6% pullback. And that's the way he ended up taking a look at it. If we continue to go up, we could have a pullback to certain levels. What would end up happening in that, in that 2035 level, around that 5% pullback? And you can end up seeing here what we would end up having a pullback by the end of September if implied volatility ended up moving here. Now, one thing that I do want to end up just mentioning is that if we do have a significant drop, what this is showing is that implied volatility of both the put and the call will end up going up an equal amount. And that may or may not happen, right? What will happen is that the implied volatility is already and if I come over here, the implied volatility is already at 17. So if I take this one up 20 points, I'm taking that up to 37, and I'm taking this implied volatility up 20 points, and I'm bringing it up to 29. Will that same ratio hold? Well, it depends on if we get flatter than we normally would end up being. The answer would be yes, and that's what would normally end up happening. If we had steeper, the answer would be no. So we went through the assumptions that what would happen if you wanted to end up getting out of mid-trade. And I would say that you guys as options traders would think about that a lot more than he did, because what he was much more concerned about was the expiration graph. He said, because I plan on holding this. I don't plan on getting out of it. Okay. Might he get out of it if we end up running up, and it's near expiration and there's a lot of time premium in here? I'm like, yeah, you can. If you want to get out of this a week beforehand, because we're hovering right above the long call, and you know that it's going to end up decaying pretty dramatically, we could sell that long call the week before, the month before, 3 months before if you wanted to. And so it kind of ends up just depending, right? The flexibility that he'd have from this trade, from actually doing a structured note from Goldman or whoever, was much, much stronger. Okay, he had so much more flexibility doing this than if he bought a note. Okay. Any other questions?
Well, that's true. I like the idea of self-managing it because you're not tied to someone else making the decisions. I mean, you could set this up so that the call you sold, when it got to 20% of what you sold it for, you just closed it. So if we had a run up, then you'd be able to participate in the whole run up.
Right.
Because at some point the call is not going to help you on the downside anymore if it decays away, which they tend to
Mm-hmm.
quicker.
Yes, they do. Yes, they do. What Paul is saying is that he's been involved in some of the same studies that I had. Is that the 13% below the money put? This will end up decaying away much, much, much quicker than this will decay. And don't just think that the 1 cent of theta here, okay, versus the 2 cents of theta here makes any difference today. That gets bigger as time goes by. Okay, it actually gets bigger until this thing actually then gets close to zero. Right? You can't have a 30 cents of theta, okay, when you have a 20-cent option. Okay. And so it'll end up getting bigger until it loses most of its value. So it will lose its value at a much more rapid rate than my call will. So the logistics of just the way the implied volatility and the decay works is also on our side in this trade. Why? It comes back down to what I said before, right? There are just so many benefits if you buy low volatility and sell high volatility. That's the way you get edge. And Paul, when you end up telling your investment manager friend Michael, okay, just let him know where you got the idea.
Okay. Well, they prefer to spend their time on the boat than sitting in front of computer screens. So.
I know they do. I know they do. That's why that's the beautiful thing about this. He has to put on one trade, and then he can get back on the boat. Okay.
Yep, that's right.
Get off in August. I mean, in March. Okay, guys. Any other questions from in the chat or anybody who's dialed in?
Oh, this was very interesting.
Okay.
I always wonder why anyone would ever trade a bespoke product with Goldman Sachs when you have to go back to them to get out.
Right.
Yeah. Well, there's I won't discuss here some of the advantages of being with them, but I wouldn't do it. But he's got some advantages that we don't have.
Yes. There are very good reasons to end up being okay when you're managing, a few $100 million. There are a lot of good reasons to end up being with Goldman Sachs. Not the least of which that you have access to some of their systems, but the bespoke products, right? The customized products for something like this. You can build on your own. But many of their products that they would end up selling to their institutional or their extremely ultra net worth.
The Muppets, yes.
The Muppets. There are a lot of smart Muppets, by the way. That was just Goldman being as arrogant as they always are. I will tell you that because I have met Paul's friend. We've played golf together. He's no Muppet. Okay, no. He's a brilliant guy. Okay. I don't see any other questions. If you guys do this, just realize, okay, the risk that you're taking, and I will leave you with this one final risk. If you do this and you put this in an account, while it will tell you that the cost of this will actually put some money into your account and your margin is only $2,300, that's not the way that they would end up looking at it. They being the RIA, they would end up taking a look at it that we actually have a total risk of about $10,000 or even more. It should be $20,000. I was like, it does go if the S&P went down to zero. Okay, so that is your ultimate theoretical risk of where you end up going, and so they would not end up leaving just $2,000 in margin here. They probably wouldn't leave 20, but I can tell you that they'd leave at least 2 to 5 times that. Okay.
Would it hurt to trade a lot to put a really cheap put all the way down, just just to to create a credit spread rather than a naked short?
And we looked at that, right? The thing is that at that point, you're looking at probably going down, significant. And at that point, where are you going to put that really cheap put? It's out so far. You're going to spend a dime for it? Okay, we got 40 cents. You want to get rid of all 40 cents? We have to go now down to 160. And when I end up putting on 160, if you take a look at the margin requirement, right? The margin requirement practically doesn't change, okay, when I click it on or off right now. The only reason why that would be, instead of putting the 4,000 or 5,000 down, it actually shows you here's what your risk is. So you're buying something just so far below the money. It's way more than a tail, and I am paying 26%. So can I end up putting that on? It's not a terrible idea. If you were doing this for yield, they probably wouldn't do it. If you're doing it because I got a little bit of extra gain and you're just doing this for a true break even, you spend your extra money on a put that far below the money, and you want to be able to end up doing this, in an IRA. You want to end up doing this in a way that if you do lose mom's money, she won't write you out of the will. Yeah, yes, yes, you can. So, anything else? Okay. Paul, I don't know if I heard this one with you because I ended up making the joke about being written out of the will. Was it you who ended up telling me that you finally figured out why diapers were named what they are?
It might have been. I can't remember. I'm an old guy. But I'm
Okay.
pretty sure.
What? I don't know if it came from Paul or somebody else, but it went like this. He said, I finally figured out why diapers are named, okay, the way they are. Because when you think about baby diapers, they're named Pampers and Loves and Huggies, because even when they end up making in their parents, the parents are still going to pamper them, they're still going to love them, they're still going to hug them. But
Right.
when an old person ends up, okay, crapping in their diaper, okay, which are called depends, the only person who's still going to love them, it depends on who's in the will.
Yeah, right. That was me. Yeah.
Which I found very funny. Thank you. Okay, thank you, Paul. Anyway, guys, thanks a lot. Hope this was useful. If you do have specific questions, or you have one that you want to end up running and it's a little bit different than the one that I ended up showing you, you can always write me an email. I'm jim@capitaldiscussions.com. I'd be more than happy to go through, okay, your specific example if you want to put one on. What I'd end up asking is that, we keep track of it. I wouldn't end up sharing your trade unless it was okay with you, but I'd love to be able to end up keeping this. What I'm going to end up doing is that I'm going to lock this thing down at 42-cent credit, not a 43-cent credit, because I know that there might be a little bit of slippage. Okay, and we will end up tracking this one every once in a while, and we'll definitely look at it, when it comes due in March. Okay, so write me any questions you have on it. I'll be glad to end up answering them. Thank you, everyone.